And now that we have your utmost attention, ladies and gentlemen, I'm going to once again urge all of you to take your seats as we now deep dive on finding out more about balancing innovation with financial stability. And that being said, I now request you, sir, to please address the August gathering.
Good afternoon, distinguished policymakers, members of academia, industry leaders, and innovators. It is both a pleasure and a responsibility to address this gathering on a subject that is poised to shape the future of finance, in addition to various other fields of human activity. It is going to change finance, society, and governance alike. And the subject I'm talking about is artificial intelligence. Most of you would obviously know about this, so I will not really go into defining it. AI, or artificial intelligence, has rapidly evolved from an academic discussion less than a decade back to become an integral part of our daily lives today. We encounter it when we unlock our phones, interact with chatbots, and increasingly when accessing financial services. In just a few years, AI has evolved from an enabling technology to a foundational driver of how individuals and businesses make decisions. Globally, AI is already reshaping financial systems, from digital credit underwriting to conversational banking assistance. AI is demonstrating its ability in ways unimaginable a few years back. India, too, has been a notable participant in this journey. Yet, as with all powerful innovations, AI carries a dual narrative. It promises extraordinary efficiency, inclusion, and innovation. But if left unattended, it could pose unprecedented threats. As Stephen Hawking, the Nobel laureate, the famous physicist, said in 2016 at the launch of the Center for the Future of Intelligence, the rise of powerful AI will be the best or the worst thing that ever to happen to humanity. We do not yet know which. It is acknowledged widely that AI could be the permanent answer to poverty and disease. But equally, there have been concerns from AI experts, ranging from concerns around bad actors using AI for bad things, to the more fundamental concern that human existence is irrelevant once machines achieve superintelligence. I do not intend to dwell on these widely divergent possibilities, but I raise this point only to highlight the fact that while the benefits of AI are transformative, they need to be used responsibly. In finance, the margin for error is even narrower, as financial institutions are built on trust and economies prosper on stability. Therefore, the integration of AI in financial systems must be approached as a matter of profound responsibility, with due recognition and mitigation of risks. What are the benefits of artificial intelligence specific to finance? I wish to spend a few minutes here. The promise of artificial intelligence in finance is by now, of course, well recognized. At its core, AI can expand financial access, strengthen safeguards, and reimagine efficiency. It can lead to better credit assessment through use of alternative data like transaction patterns or utility payments of unbanked customers. Ability to use massive data sources could help in real-time detection of frauds through identification of unusual transaction patterns or improve market risk modeling. Operational efficiency and cost reduction can get a paradigm shift using AI. For example, in back office processes or KYC or loan processing, etc. Chatbots and virtual assistants would make customer support 24/7. Data extraction from financial documents through natural language processing could make document processing virtually seamless. In the investment and trading space, the ability of AI models to detect short-term price inefficiencies are already being harnessed. Other benefits include allocation optimization, use of big data to forecast market movements, etc. AI-driven RegTech applications help regulated entities with better compliance outcomes. Automated monitoring helps detection of suspicious transactions and generate faster compliance. AI has potential to significantly expedite financial inclusion through alternative credit scoring models, for example, while language interfaces will remove language barriers and reach digitally limited customers. Investment advice becomes affordable to small investors through robo-advisors. This and many of the risks is what makes this financial technology so much more exciting. But these benefits come with significant risks. AI systems are trained on vast amounts of data. It is natural that the learnings from the data would also extend to learning the bias inherent in the data. AI systems trained on biased historical data are likely to perpetuate or amplify historical discrimination in, for example, credit profiling or hiring. Even small biases in training data can lead to systematic exclusion of population groups from accessing financial services. Algorithmic opacity would make it very difficult to identify possible biases upfront, which makes the problem even worse. The black box problem of AI models, or in other words, the lack of explainability of AI decisions, makes these models non-transparent. This makes it hard for regulators and auditors to understand how decisions are made, which in turn undermines accountability. Regulatory actions or denial of service to customers would typically require reasons to be communicated. Absence of explainability, therefore, could constrain the use of AI tools. There are systemic risks typical to AI systems, such as herding behavior when AI-driven trading models get widely used, which in turn could lead to amplified volatility. AI misjudgments can trigger market dislocations. Such problems are amplified by the possibility that it becomes difficult to assign responsibility when an AI model makes a harmful or erroneous decision. Legal frameworks would always find it difficult to catch up with very fast-moving technology. Over-reliance on automation could result in losing oversight or in delayed intervention when things go wrong. There is also the ethical issue of using behavioral data for manipulative cross-selling or risk profiling. Then, of course, there is the debate about AI and job displacement. Whether AI will displace jobs in the long run would depend on whether it is like other transformative technology changes of history, like the Industrial Revolution or the invention of electricity, or rather the discovery of electricity, or whether it is a fundamentally different kind of change. Max Tegmark, the founder of the Future of Life Institute, argues that while all past technologies amplified human ability, they did not replace human intelligence. AI is the first technology that creates intelligence itself. Now, what this essentially means is that it could actually make the human brain redundant, which is not a possible outcome that humanity is used to dealing with so far. Recognizing these risks is not to diminish the promise of AI, but to underline the importance of adopting it responsibly through safeguards, governance, and foresight. The key question, therefore, is how do we enable innovation while safeguarding systemic stability? This balance is a necessity for ensuring that AI strengthens rather than undermines the financial system. If regulatory frameworks are too rigid, they can dissuade experimentation, reducing AI to a tool deployed only by the large players. On the other hand, unbridled adoption, particularly in high-impact areas, could create vulnerabilities that are invisible until they snowball into a crisis. The balance is not only about restraint, it is also about actively encouraging innovation. This requires policies that create safe spaces for experimentation, such as sandboxes, facilitate open digital infrastructures, and provide access to quality data, enabling firms to innovate with confidence. It also requires incentives for responsible innovation so that firms see governance not as a burden, but as a competitive advantage. As we reflect on the transformative potential of AI, it becomes imperative to anchor its adoption within a framework of principles. The RBI took a step in this direction through setting up the Free AI Committee, which has articulated a set of guiding principles, or sutras as it calls them, for responsible and ethical adoption of AI in the financial sector. These principles are intended to serve as touchstones for all stakeholders. At the core is the principle of trust, the bedrock of finance. Every deployment of AI must reinforce, not diminish, the trust of consumers, institutions, and society. Equally important is a people-first orientation, ensuring that technology serves human needs. This report emphasizes innovation over restraint, coupled with fairness and accountability in outcomes. AI can inform decisions, but it cannot own them. The accountability must always rest with human actors or institutions deploying AI. The principle of understandable by design underscores the need for transparency, ensuring that AI decisions are explainable to both regulators and consumers. And above all, safety and resilience must be built into every layer of adoption. Alongside regulatory oversight, it is equally critical to encourage industry-led codes of conduct, self-regulation, and the institutionalization of ethical standards. This collaborative approach ensures that responsibility is not a mandate of regulators, but a shared culture across the fintech ecosystem. The RBI has always fostered innovation with safeguards. Through calibrated guidance, supervisory oversight, and structured engagement with industry, the RBI aims to foster an ecosystem where financial innovation flourishes without compromising systemic stability. As AI reshapes the financial landscape, this approach remains unchanged. Progress and prudence must go hand in hand. RBI has also taken initiatives for the industry through RBI Innovation Hub, such as the MuleHunter.ai, for combating the menace of mule accounts. Unlike the traditional rule-based system currently used, MuleHunter offers greater accuracy and precision with significantly low false positive rates. Currently, the model has been deployed in about 20 commercial banks. In addition to Mule Hunter, work is also underway to explore a digital payments intelligence platform that can analyze and assign a risk score to transactions on a real-time basis. While AI holds immense promise, excuse me for a moment. While AI holds immense promise, the financial system demands the highest degree of prudence. Critical infrastructure and institutions must be ring-fenced from unchecked risks that could arise from untested or poorly governed AI deployments. The objective is not to obstruct innovation, but to ensure that its application never compromises the stability or integrity of the system. To this end, practices such as stress testing AI models under diverse scenarios, red teaming to identify vulnerabilities, and the adoption of explainability tools and standards are indispensable. These mechanisms would help regulators and institutions alike to supervise AI outcomes, detect weaknesses before they escalate, and ensure that AI-driven decisioning can be understood and, if necessary, challenged. Equally important is that AI systems are subjected to rigorous oversight and layered with inherent checks. Financial AI applications in particular must be designed such that they cannot inadvertently destabilize markets or payment systems or consumer confidence. This approach demands safety by design rather than safety as an afterthought. Safeguards must be embedded throughout the life cycle, from conception and data training to model validation and real-world application. Retrofitting safety once risks have materialized is inadequate and potentially destabilizing. Embedding AI in finance is not a one-time exercise. It demands continuous research, experimentation, and learning as models, techniques, and risks evolve rapidly. It also calls for partnerships among industry, academia, regulators, and startups. Co-developing solutions, sharing knowledge, and stress testing innovations must be fostered. Entities should have in place systems for responsible data governance, ethical sourcing of data, and privacy by design in every model. They should develop common standards, toolkits, and disclosure mechanisms so that model design, training data, and decision logic can be explained. Safeguards such as digital watermarking of synthetic content should be explored to deter misuse. Internal policies and processes must be revised to embed AI risk assessment into product lifecycle. Continuous monitoring, stress scenarios, and independent audits should be institutionalized. What is the way forward? As we look ahead, the path for responsible AI in India's financial sector is exciting yet deliberate, demanding a phased approach that balances innovation, inclusion, and stability. Alongside technological progress, the human element remains critical. AI literacy for consumers to understand both the potential and risks of AI will be central. Just as financial literacy has been a national priority, the coming decade will require a parallel focus on AI literacy for individuals to engage confidently and safely with these new tools. In the short term, the focus needs to be on awareness and capacity building. Financial institutions, technology providers, and regulators must train personnel, strengthen internal governance structures, and introduce initial risk frameworks to ensure that AI deployment is encouraged with a focus on safety. Awareness campaigns and workshops can also help smaller institutions and fintechs integrate AI responsibly. In the medium term, free AI principles should guide the industry practice. AI can begin to play a substantial role in soup tech, credit decisioning, and financial inclusion. In parallel, the industry should develop its own governance standards, self-regulatory codes, and ethical guidelines to complement regulatory oversight. In the long run, India can aspire to become a trusted global hub for responsible AI in finance. By demonstrating how innovation can coexist with strong safeguards, India can set an example for emerging economies and the global south, attracting talent, investment, and collaboration. I would now conclude. As we conclude, it is essential to reiterate that AI must remain a force for good, empowering individuals, strengthening institutions, and enhancing the resilience of our financial systems. Its promise will be realized only when adopted responsibly, with constant attention to its societal impact. Responsible AI should not be framed merely as a regulatory requirement, but as a matter of business ethics. Every model deployed, every decision automated, and every service enabled through AI must reinforce the confidence of consumers, provide fair access, and respect the dignity and privacy of all participants. Let me leave you now with 5 guideposts, not as tasks, but as a collective mission. We can call them the 5 T's. The first is trust. I've already talked about it. Commit to building AI systems that uphold and enhance trust in the system. Embed responsibility and ethics in every algorithm. Second is transparency. Reinforce clarity and explainability in AI, ensuring that decisions can be understood, audited, and questioned when necessary. The third is training. Invest in training to nurture a world-class AI talent within our financial ecosystem. Ensure India leads in creating, not just in consuming. Fourth is technology for good. Let innovation be guided by purpose. The test of every AI application must be whether it advances inclusion, resilience, and efficiency. And 5, togetherness. Above all, we must work together, regulators, industry, academia, and global partners, to collaborate and co-develop. Through shared commitment, ethical deployment, and continuous vigilance, we can ensure that AI fulfills its promise as a transformative enabler. Thank you so much.